Hey, welcome back to Beyond the Books, the show where we help you survive and thrive after college. Today, we have got a very, very important topic that a lot of people in Boba Talks have been asking about, which is personal finance. Definitely a great episode that we have for you today, but also it's exciting because we're doing, for a very first time, a two-parter. So we'll actually be doing this as a recorded episode so you can get all of the kind of basics answered. But we'll also be doing a live show for you in December. So look out for more details on that, but know that you'll be able to ask some of your personal finance questions live to our special guest. Which, speaking of, I'm actually going to kick it to Ben to introduce our guest today because I think he probably would really want to introduce this one.
Yeah, absolutely. We had a special guest last episode for Tyler, and this is my sort of special guest. But welcome to the show, Albert, who is my older brother. He's been my lifelong mentor, literally. In fact, I kind of was thinking to myself, like, if everyone had an Albert, we probably don't need Boba Talks to exist because everyone's really in good hands. He's sort of a financial advisor by trade, but he's also my big brother. And he's been through and helped me with every single decision I feel like I could have made in my life. So I'm just really happy to be able to share his wisdom with all of you all. And Albert, welcome to the show.
Thank you guys for having me. I've heard lots about Boba Talks, and so I'm really excited to be here. As Ben mentioned, I am his older brother. I am a financial advisor. I've been in the wealth management industry for a little over 10 years now. In my career, really, ultimately, what we're trying to do is help families, grow their wealth, right? Be able to achieve their financial goals, but beyond that, really just take care of the family from a financial aspect. So certainly happy to be here. I'm excited for the episode. And so, yeah, I'd love to kick it off.
Well, we've got a lot to talk through, but I think a great way for us to get started is to talk a little bit about our own personal finance stories. I figured I'd start this one off just because I've had a little bit of a journey in personal finance. When I graduated college, I was fortunate to have had a few internships under my belt, and I'd saved up a little bit of money, and I got a job after school. And when I moved to my very first apartment in San Francisco to do that job, I actually moved in about a month before I started that job. So no income yet, just a whole bunch of expense. And I, got really excited that I had some money in my account after those internships, and I bought a car, and then I paid my security deposit. And from a budget perspective, there was a positive balance in that account, but it certainly wasn't much. And so I go to move into that apartment again with no paychecks yet, and I basically find out that I would have to pay an extra $300 to get some padding on the elevator if I want to move in my actual stuff. I did not have $300 to pad the elevator at that time. And so for the very first month of my life after college, I slept in that apartment on this makeshift floor. I don't think you can call it a mattress. It was a blanket.
It's a blanket.
And then another blanket. It was just a struggle of a situation. But basically, I learned very early on that personal finance was something that was going to be absolutely critical to actually navigate adulthood. And very quickly after that, had to learn about how to manage a budget and manage my money. So in any case, for those out there who, might be sleeping on the floor, I'm with you.
So what Tyler is saying is, please pay attention if that is you, because we don't want you to make that mistake when you get to the point. We want you to be sleeping on whatever you prefer to sleep on. There you go. Done.
Very true.
And I think on that note, I do want to say from a personal finance perspective, right? Oftentimes, the number one stressor I hear from clients oftentimes is from a money perspective, right? Can't sleep at night because I got bills, I got this, I got that. And so I think really what the goal for today is trying to alleviate some of that, right? To show how money can be used as a tool, right? A means to an end, right? So, there's the old cliche of money can't buy happiness, but it certainly can help, and so hopefully by the end of today, we give you a little bit of insight on how to leverage and utilize that tool to take a little bit, off the shoulder, right? And so that we can sleep a little better at night and not on the floor.
There you go. There you go. Yeah, and I think like my reason for why this is important at every single age, whether you're a college student or well into your career and you haven't thought about financial planning, I have two thoughts. One is more personal. So Albert and I, our parents did have some pretty serious health conditions as early as when we were in like high school, early college. And, looking back, I think, medical debt is definitely one of the top things that can really crush a person's finances, and just making sure that you have that rainy day fund. It takes planning. It's not something that you can just be like, oh, cool, I can just like whip up, my safety net or anything. Like it does take planning. Not everyone is fortunate to have the privilege to plan, but I'm hoping we can arm each of you with some knowledge so you just ask yourself some of those questions. Unfortunately, these unforeseen things happen all the time. So I think it is important for people to kind of think ahead before you have to cross hey, this unforeseen thing came up. Hopefully it's not as serious as parents' health and all that, but stuff does happen. And I don't want people to sort of be taken by surprise. And the other thing I wanted to highlight is around compounding. Compound interest in particular is something that essentially is the best the sooner you do it. So I'll share my screen. There's a visual from a website called wealth.visualcapitalist.com. For those of you listening on the podcast, no worries. I'll narrate it, but there's two different paths it shows. It shows a gal named Jessica that says she just graduated from college and is a stingy saver. And we've got Newman, who essentially graduated college, but is waiting a little bit later. Now, if we follow their paths, you'll see that Jessica, as an example, at 25 years old, she invests $5,000, whereas Newman, at 35 years old or 10 years later, invests twice as much as Jessica, so $10K. So Jessica's got 5 in the bank, Newman's got 10. We take the example and you'll see that Jessica follows that up, saving $2,500 each year until age 65. And Newman essentially does the same thing, doubles Jessica's investment at $5K until 65. So again, just to take a step back, Jessica starts at 25, invests $5K, follows that up every year with $2,500. Newman, on the other hand, starts at 35 years old, invests twice as much as Jessica, so $10K, and follows it up with twice as much as Jessica each year at $5K until he's 65. So who actually gets to save more money at the end? Well, in this example, actually Jessica has more money. So what I wanted to kind of show you all is the magic of compound interest starts best when you started yesterday. And yesterday is gone, so the next best time to start is today. So we can probably plug this link into this episode, but just wanted to highlight again the magic of compound interest, and we'll be sharing with y'all many, 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 many ways to get there. So now that we've given you a couple reasons of like why this is important, we want to get into the meat of the conversation and structure it a little bit in the following way. So we'll actually break this into 3 different stages, which we're calling survive, which is like I'm about to start work, or maybe I have my first paycheck. What does that look like in terms of financial planning? We have sort of this strive category, which is like you've got your feet under you a little bit, and now you're thinking about sort of a little bit more advanced ways, or you're thinking about maybe things you want to save for. We've got a section for that. And then we've got the thrive category. So that category is going to be, Albert, just so you're aware, like super, super advanced. You feel really good. You're maybe 5-10 years into your career. We're not going to spend a lot of time on that, and we're hoping to use a live Q&A session to chat more about that, but we will be spending a ton of time in the survive and the strive category. Hopefully give y'all some tips, and we're going to have Albert kind of walk us through all of the fun things that he'll help us understand. The other thing that we're going to do is we're going to use Tyler and I as sort of illustrative examples. So just to give Albert some ammunition to use to help us understand what might make sense for us. So in our example, we're going to say, Ben, myself, I'm a new grad. I'm making 40, 50K a year, like entry level stuff. I live in a high cost location. I've got some student loans, but the most important thing is my appetite for financial risk, which is true, is fairly low. So don't hit me with any of the crazy things, but, give me the stuff that I'm going to feel very confident about. And in this case, I'm not super financially literate. So don't get too, fancy or cute with me. Whereas Tyler is going to take on the illustrator persona of, he's a little bit more established, worked a couple years in the industry. Let's say he makes sort of 80K in a medium to low cost location. His student loans are cared for, no major debt. He has higher acceptance of risk, and he's very interested in the financial sector and all that. So he's definitely more self-motivated to do some reading and do some work there. So we're hoping that as we learn about some financial tools, we can kind of think about what could make sense with Ben versus Tyler, and hopefully that'll give you a sense on how that goes. So last thing before we get started, and Albert, I'm gonna kick it to you. Of course, this episode is meant to provide financial education. It is not meant to provide financial advice. Everyone's situation is very different. We do have many listeners who are in Canada, international. Like, we're going to be very US centric, but still going to be valuable. But all that to say, this is not financial advice. If you want advice on your specific situation, you should contact an expert. So with that, gentlemen, anything I missed, anything we want to cover before we get into the survive category?
I'm ready.
All right, let's do it. So survive, as I mentioned, Albert, the goal is, let's say we're seniors in college or about to be a new grad, like all we've got are the basics, and, don't hit us with any jargon. Talk to us about how you would coach someone through thinking about financial planning in this survive stage.
Yeah, sure. And really to take it truly from the basic, right? I think we start from just your basic everyday banking services, right? I'm sure most people are familiar, but at the banks, you can have different accounts, right? A checking account, a savings account. That's going to be your bare minimum, right? And typically your checking accounts where money comes in and out, right? Your paycheck gets deposited there. And then your savings account traditionally has been where you would park potentially maybe some excess cash, right? It's called a savings account because it traditionally provides a savings rate. Now, we're in an interesting environment where savings account today, at your local bank may not provide you with potentially the highest sort of savings rate, right? So if you go to open your bank account and you have a savings account, you look at the interest, it's probably somewhere sub 1%, right? So it's not doing a whole lot, and so. From that perspective, I think everyone should have these accounts, right? But also know that there are other tools and options out there. And we'll probably touch on some of these today, kind of at a high level, right? So another type of savings account that is becoming more and more popular and common is what's called a high yield savings account. And often you can open these at your bank accounts, online bank accounts. These offer a greater savings rate. Right. So I certainly highly encourage folks out there who, are just starting out, have a little bit of excess cash, right, to look into that. Now, with that said, I think from a scenario that Ben just painted, right, you're starting out, you're just making a little bit of money now. I think the first thing that we obviously want to really consider is having your rainy day fund protected. Right. Creating a rainy day fund so that, in case you incur the unexpected, right, which comes unexpectedly, that you're protected. And oftentimes there's no magic sauce to it, right? Oftentimes people go 3 months, 6 months, a year. Ultimately, that's going to be a personal choice, right? It's again, what amount helps you sleep better at night, right? And I'm going to go back to this sort of thought a lot, right? Sleeping better at night. So the idea is if you are feeling comfortable that, let's say you lose your job, right? You started working, but, for some unforeseen reason, you're unable to work and you have a loss of income. How much do you need to have to continue feeling comfortable knowing that you're going to be out there looking for a job, right? In your industry, is it really popular right now? You can find a job in 3 months. Is it, harder to find right now, just given, the economic environment? Is it 6 months? Is it 12 months? And it could be a sort of moving scale. Right? It doesn't necessarily have to be, okay, I hit 6, I'm done. So again, it's a very personal sort of topic. Now, beyond that, right, having your rainy day fund kind of set aside, and I would say that would probably sit in your either high yield savings account or some sort of savings account. Your day-to-day sort of expenses would sit in your checking account. And then beyond that, I think as you start working, right, the idea that Ben mentioned of compounding is extremely powerful. All right. The idea of starting early, the idea of saving, and really putting that dollar to work by investing, in the market, certainly will make a difference in the long run. Right. So this kind of moves into that next topic of retirement accounts, 401ks. Oftentimes at, a lot of employers, there will be some sort of retirement plan that's available. Right. Most commonly, it's the 401k these days. Excuse me. And so in a 401k, it essentially allows you a tax deferred retirement savings account. Right. And it's truly, you can use it however you want. You can leave it in a money market in a 401k. You can invest it. Right. The option is yours to choose. But by doing so, you have some tax advantage. Right. By deferring, some of your paycheck to a 401k, you're able to, one, reduce your taxable income. Two, you tuck money away pre-tax and it grows tax deferred. And what that means is, generally as it sits in that account, right, as it grows, you're not going to be subject to income tax or capital gain tax as you would if it was just like income to you, right? That dollar comes to your pocket. Before it gets into your pocket, the government's going to tax on it. You got Social Security, et cetera, et cetera. Okay. So it's an extremely powerful tool. And then beyond that, oftentimes employers will have certain benefits, right? Most commonly, you'll see some sort of matching program. And so that's really to incentivize employees to participate. But what I'll say is also, even if your employer doesn't do any sort of matching, just because of the aforementioned reasons, I think it's still really important to contribute some. Right. You don't have to max it out if we're not quite there yet. Right. But I think even if it's, $100 a month, all of that will make a difference in the long run, especially if you're early in your career. Right. So I highly encourage you to, if you're not doing it already, look into it. Now, the other thing I want to mention is, in case for some reason your employer, doesn't offer a retirement plan, there are other vehicles that you can utilize, right? And that would be potentially a traditional IRA or Roth IRA, right? The IRA is an account you can open yourself. Right. Every year there's an annual limit and you can look into that yourself. But if your employer doesn't allow for any sort of retirement plan, I would still encourage you to look into setting one up for yourself. It acts essentially the same way. You can contribute into a traditional IRA, which stands for individual retirement account, right? Pre-tax, or you can contribute to what's called a Roth IRA on a post-tax basis. Now, quickly to give a little bit of description between the two, on a traditional IRA, you're using your pre-tax dollar, or you're contributing essentially pre-tax dollar into a traditional IRA. And what I mean by that is you're going to take money that you receive from your paycheck and you're going to contribute it into this traditional IRA. And then, when you file your tax return, you'll say, hey, I made this contribution, so it should be a deduction against my taxes, right? Your income taxes. In a Roth IRA, you're using post-tax dollars. Right. So similarly, you'll take dollars out of your paycheck, you'll contribute it. Now, you wouldn't be able to take a deduction on this, but the difference here is in a traditional IRA, because you put in your dollars and you get a deduction, the growth in that is tax deferred. Right. So everything that grows in that account is tax deferred until you decide you want to take it out at retirement age. When you take it out, it becomes taxable to you again. In the Roth IRA, the difference is because you're using post-tax dollars and you're not getting a deduction, when you take it out, when you put it in and invest it and eventually take it out, that becomes tax-free. Now, obviously, this is not tax advice, and I certainly encourage you to speak with a tax expert on further, in the subject regarding your personal sort of situation. But regardless, I think there's a vehicle out there for everyone to take advantage of. Okay. So I know that was a lot right there to start. I wanted to see if you guys had any thoughts, any comments, anything you'd like me to dive deeper into.
Yeah, I was going to quickly throw something out there. So one thing that I think is important for people starting new jobs out of school to understand too is if you have an employer that has a 401k, if you decide to leave that employer, that money isn't lost. That money isn't something that just magically goes away. I think one thing that I learned kind of as I navigated career and kind of job changes was that there are things called rollovers where you're able to actually move the money that you had saved up within a 401k into either a new 401k plan at a new employer. Sometimes you can maintain it with the old employer. That's a conversation for another day. Or you can also potentially roll your 401k into an IRA plan, one of these individual retirement accounts. I say that mostly because I have talked to some students and folks who are early in their careers who are like, I've been saving, like it's all going to get lost. It won't get lost. You're allowed to kind of navigate career changes and still be good for retirement. So I did want to add that in just because it's something that has come up. One question I have for you though, Albert, is kind of going back to checkings and savings accounts and kind of the importance of compounding. I've seen a lot of TikTok trends where folks try to give different versions of financial advice. One of the really hot ones right now is cash stuffing. I'm kind of curious what your take is on cash stuffing, if you know what that is, and if you think folks should keep that money in a bank or put it into the envelopes.
Yeah, I might be aging myself here, but I've actually haven't heard that term before. So, is that the idea of just like actually holding cash versus using a bank?
Yeah, so basically cash stuffing is when folks get their paycheck, they immediately take it out of the bank, they put it into envelopes for different things. So your rent, your utility bills, whatever it is.
I hear you. So, my take on that is, and maybe to take a step back to kind of touch on another topic really quickly that I think is really important, and you'll see a little bit about it on the screen, is FDIC insurance, right? The reason we have these banking institutions is for us to have faith in the banking system, right? And so every bank insures their clients or each depositor an FDIC insurance. And so each person at each institution gets $250,000 of FDIC insurance, right? What this says is if something happens to this bank and the bank goes under, you are protected up to $250,000 per person, per institution. Right. So, and we've seen it sort of work out, right? In historical, there have been times where banks have had challenges. Most recently, we saw Silicon Valley Bank go through it. Everyone got their money back, right? And a big part of that was due to FDIC. Now, it gets a little more nuanced than that, and again, we won't go into it. But I think, because of that sort of protection, I'm still a big believer in, at least parking some money in in the bank, right? And I think these days there's a lot of great resources out there for budgeting. It doesn't necessarily mean you have to, physically use the cash and put it in envelopes and set these goals aside. I think that's a great way to budget, right? Compartmentalizing, setting different buckets for different goals. I am very much about that. But having physical cash, I think presents different risks, right? And I'm not saying it's not a bad idea. I think if it works for you, excellent. I certainly encourage any sort of, doing something's better than nothing, right? At the end of the day. So if that's what works and gets you to really, hone your budgeting skills and really implement, then great. But I think for, folks that may be a little tech friendly, there certainly are resources out there for you to do it maybe digitally, and I just think cash in the bank is well protected, right? We don't risk having dollars lost and all that. So again, this is just kind of my opinion, right? I preface all this by saying everyone's going to be different, everyone's situation is going to be different, so whatever works for you. But I think ultimately at the end of the day, having a budget and actually doing it is better than not.
And for those of you who are listening to the podcast, our apologies. We've had a document up that has a table of the checking account, savings account, and retirement accounts in the rows, and then sort of like what it is, why you might want to use it, or the risks. Under checking account, I wrote this doc and I put why you might want to consider a checking account. I put better than hiding cash under your mattress. So apparently, maybe some people might disagree with that. Or in the case of Tyler, you don't even have a mattress, so you'd have to like stuff it in a sock in the cabinet or something.
Just one thin layer under that one blanket that I have.
Just of ones. You've got like $30 as a mattress. Yeah. So maybe every situation is different. But Albert, I wanted to bring back some of these tools to sort of the illustrative personas Tyler and I are supposed to be. What I'm hearing is both of us, everyone, regardless of your financial situation, should be really starting off with some sort of a checking account or some way to sort of transact money somewhere where you save enough money for a rainy day, meaning sort of like the unforeseen circumstance, if that's in your pillowcase, if that's in a bank, like power to you, whatever. And then think about retirement accounts. I know it's very popular to be very cynical as a young person, to be like, why would I think about a future? None of us are going to make it in the next 4 years out anyway, or whatever. So I do also want to caveat that and say, like, yeah, that's it's a fun joke, and like generally totally hear what you're saying because you're barely struggling and getting by. Like, I understand. You also don't want to be the person that has to work past 65, past 70, past 75, past 80. There are people like that who just simply can't afford to retire. And if you think the hells of corporation and working are bad, just wait until you're 65 and you have to continue to slog at a 9 to 5. Like, that's just not where you want to be. And with compound interest, the best time again to start is now. So is that right, Albert, or anything else you would give specific sort of points about for either Tyler or myself?
Yeah, no, I think regardless of the situation, right? I think the last few points that we talked about certainly apply to everyone. Now, it may not apply fully, right? But at some point, somewhere along your life, one of these things or all of these things will be applicable, right? Like I said, the 401k, the retirement accounts, those are, at the end of the day, you still got to be able to pay your bills and survive, right? And so if it's tucking away $100 a month, if it's none, for a few months, and then you save up a little bit and you feel comfortable, like everyone's going to have a different starting point. But again, just to kind of keep reiterating, like what you were saying, right? Starting today is better than not. So certainly highly encourage everyone. I think this is truly something, like these three things is truly, something everyone should look into, if not already have.
Cool. Then let's move on to the next. And one last point I was going to say, Albert, is like, if you don't have the means to save, that's totally okay. I know we're going to get into it, but comparing your financial situation to someone else's financial situation is probably the worst thing you can do.
Absolutely.
Just because there's everyone's on their own path. So I know we're here talking about like how to save, and like if you're living paycheck to paycheck, that is highly, highly respectable, and you do what you need to do to get out of that particular situation or get by through that particular situation until you find yourself at a point where you have the means to save, and then you come back and you listen to this conversation. So we're not trying to sort of shove some privilege crap down your throat. The reality is you do whatever. If it's saving $5 a month, you celebrate that, because again, all we're saying is knowing that these tools are out there for when you're ready. That is the biggest win that you can do. And then when you're ready to invest, you invest in. So just want to be clear about that, because we're going to go into Strive, which then kind of gets us into some areas that are a little more advanced and kind of when you're ready to save at that next level. So I'm just, again, for our listeners, I'm moving down to another table, and then Albert's going to kind of rattle off each of the names and kind of how he thinks about them. So Albert, over to you.
Yeah.
Really quick. I forgot to define Strive in some greater detail. So what we mean by Strive versus Survive is you have some financial foundation or layer, right? If we talked about living paycheck to paycheck, Strive is sort of like you're out of that kind of cycle and you're feeling like you have enough extra outside of bills, outside of rent, outside of enjoying your money in life, and you still have a little bit. Now you're getting into the phase where you can leverage these. So sorry, Albert, my apologies. Forgive me for interrupting. Just wanted to set that into context.
Can I'll also just to pepper on. Sorry, I'm gonna jump in just because to take it back to what Ben was saying. I'm gonna go back to my example of sleeping on the ground for my first month out of school. It took a few months for me to actually get to a point, especially after school, even after I started a job, to start getting paychecks and start understanding exactly what I could do with those paychecks. And it's, one of those situations where I personally, anyway, I slowly had to kind of build to what I thought was normal, because I'd seen so many other people doing what they had as normal, which to me was just like moving into an apartment and sleeping on a mattress. That was normal. And I was outside of that norm for a while. But to get to that point, it was a process, and it was a bit of a journey. And to Ben's point, it's really a personal kind of take it one day at a time, get out of kind of the debt that you have if possible, or some of the situations that are holding you back. And once you're able to kind of see from beyond the hump over there, then you're able to look back and understand, okay, I've been there, but now I'm going forward, and now I can be as smart as possible with the money. So in any case, I wanted to throw that in before we got in this drive, just because I do think you'll find, especially as you advance in your career, you advance in getting paychecks, like there will be a natural transition point where you'll get to start thinking about these things, and being armed with the information is the most important part.
Yeah, exactly. And I think both of you nailed it right on the head, right? That sort of first survive part is something everyone is probably, a little more of a practical sense, right? It's things that, we don't know what we don't know. And so really what we're trying to do today is just kind of arm you with, different levers and education so that when that time comes and you come to that point in life where you're like, great, I want to do more, what options do I have, right? And so really, from a high level, I want to touch on a few things, and and to bring it back to the original sort of scenarios, right, where Ben, as someone who's starting out his career, a little more risk averse, versus Tyler, who's a little more advanced and a little more has a little bit of a bigger risk appetite. What does that spectrum look like? Right. So starting from the beginning, something that folks may or may not have heard of already is what's called a certificate of deposit. Right. And a certificate of deposit is essentially an IOU with the bank. You decide, hey, I'm going to park, $1,000 in the bank over a fixed period of time, right? It's a contractual sort of obligation, whether it's 3 months, 6 months, a year, or whatever. And they promise you an interest rate, meaning they promise you to pay you back at the end of that contractual time frame at that whatever rate was stated. So if it was, a 1-year term at 5%, right? At the end of that 1 year, they're going to pay you 5% on your principal, and you get your principal plus interest back. These CDs are backed by the bank, so it still falls under FDIC insurance. So from a just sort of a risk spectrum perspective, this is probably going to be on the safer side, right? You're basically trusting the bank. You still have the FDIC insurance. You essentially make a contract with the bank. Okay. So maybe for someone like Ben, and even in this case, even Tyler, who maybe has some extra cash to park away, right? Going back to what we were saying earlier about compartmentalizing your goals, we're going to have near-term goals. We're going to have long-term goals. Right. And so regardless of where you are in life, I think that's still a really important way to approach personal finance, right? Is really a goals-based approach. Okay. So that's going to be based on a few things, right? Your timeline, your risk tolerance, your ability to see how much you can afford to take out of your paycheck to achieve these goals, right? And sort of adjusting it or budgeting into each of these categories. So, with that said, CDs, I think, is going to be your sort of liquid bucket, right? It's almost like similar to like your rainy day fund, where if you have a short-term goal that you need to fund in the next 6 months, well, look into parking that money in a 6-month CD, right? We're not going to take any risk on it because let's say it's to buy a car, you don't want to risk losing that principal in the market. Investing, right? Because that is the risk you take. Let's just park it in a 6-month CD, and we get you at least put that money to work and earn a little bit interest on it. So that's number one. Beyond that, then you get into truly like investing your money, right? And so moving forward, these sort of vehicles are then going to have market risk, right? So not without risk, but it's all about risk management, the risk reward, right? So given your risk tolerance, where do we want to be on that spectrum? So for someone, and I'll take a step back, but for someone who's like Ben, maybe a little more or maybe a conservative, a little more risk averse, versus Tyler, who's a little more aggressive, the spectrum can be quite wide, right? You have anywhere from conservative to aggressive, and you have the different tools to build a portfolio or build, your building blocks of your investments to say, hey, this is that tolerance that I can reach, and this is, Tyler's tolerance I can reach, right? And so what are those vehicles? Now, in the most high level, we have what's, called stocks, and then we have what's called bonds. Right. And I'll start with the bond side. Bonds are typically going to be a little more risk adverse. They're similar to a CD where it's like an IOU. Right. But there are different entities that can issue different types of bonds. The most common and probably potentially on the safer side is what we call like treasuries or government bonds, right? You let the government borrow your money, you buy treasury bonds, you buy government bonds, you essentially lend them your money, they hold it for your troubles, they pay you an interest rate. Right. And now for bonds, where the risk is the credit worthiness of that entity. Right. So in this case, the U.S. government, probably not that risky. Right. You have the whole backing of the U.S. government on that. So typically you're going to get some sort of modest interest rate. If you have slightly higher tolerance, right, we can then look at, potentially like corporate bonds. Any of like the Apples of the world, right, like they will issue corporate bonds where, they will say, hey, let us borrow your money. We'll pay you an X percent interest amount. And then from that aspect, the creditworthiness of that company is really your risk, right? And so if it's a large, reputable company, they're probably going to pay a little higher rate than, maybe like the government does, right? Because you're taking a little more of a risk, versus maybe a smaller startup who's just trying to raise some funds and issue some corporate bonds. They're probably going to pay an even higher rate, but it's a lesser known company. It's a startup. You're taking on a little more risk, right? So even from a bond spectrum, you're going to have a sort of a miniature spectrum, so to say, right? Like each of these, vehicles will have its own risk reward profile, right? So from a bond perspective, an IOU is essentially a contractual obligation of the entity to pay you, a certain interest rate and your principal back at the end of the maturity. Okay, so that's number one. On the second side is stocks, and stocks is what's going to be, we also call it equity, right? And so in this case, when you buy stocks, you're essentially buying into a piece of a company, right? So the idea is, hey, I really like this company, I want a piece of it. You can go to the stock market and purchase their stock, right? Now, stocks compared to bonds are going to be a little riskier, right? Because it's not so much an IOU anymore. It's, hey, I'm all in into this company, and I'm going to, just essentially along for the ride. If the company does well, we do well. If it doesn't do well, then you potentially might lose, right? Or lose your principal or lose something, right? Because when you go into the equities and both ways, there's going to be a market value at all times, right? So again, going back to market risk, when you invest, you have to be able to digest that risk, right? So sticking on stocks, there's a lot of different stocks you can buy. Again, large companies, small companies, right? Like startups. You can buy international companies. You can buy, sector specific, right? Biotech, pharma, tech. So you can really, drive down to, whatever sector you like, whatever company you like, right? And it's not, without risk either, right? You have a spectrum there of, large cap companies are, again, a little more well-known versus the startups, so where along that spectrum do you feel most comfortable, right? So for someone who's like Ben, a little more risk averse, we're probably going to be, and it's going to be a combination, right? Oftentimes, your profile is going to be a little bit of stocks, a little bit of bonds, and what is that mix that makes the most sense for you, right? And again, there's no sort of magical number. It's really, understanding what each of them do, right? Each of these levers, where do they accomplish in relative to what my goals might be? And so for Ben, maybe it's, who's still young, but a little risk averse. Maybe it's like a 70-30 portfolio, right? 70% in stock, 30% in bonds, or maybe it's 60-40, right? Whereas Tyler might be 90-10 or 100% equity because he's got a bigger risk appetite, right? And so it's really, again, the education and really understanding each of these vehicles and kind of deciding, where along that risk spectrum would I fall where I feel the most comfortable from a risk reward perspective, right? So I'll pause there briefly before I move on to the other two. But any comments, any questions?
Yeah, I was just going to punctuate what you're saying because I think so. The concept that Albert's going through right now for folks who are new to kind of the different vehicles is diversification, and diversification is really important because it spreads your risk out. There are so many different types of vehicles, like Albert's saying, some of them are really stable, some of them are unstable. But by diversifying your portfolio, you have the best bet of managing risk while also managing your expectations for growth. So I did want to throw that out there, just because, especially as you get more money over time and invest. If one company that you've invested in is doing well, that's great. It doesn't mean it's the only company you have to invest in. You can look at other companies, you can see what other ones look good to you, and spread out your risk accordingly. So in the event that one company you thought was great decides to crash the next day, you don't lose all the money that you've got invested. So just wanted to throw that out there. Diversification is super, super critical.
Yeah, diversification.
That's actually, no, sorry, no, go ahead.
I was going to say diversification, yes. And then I would also add, I think like time in the market and like longer term plays versus shorter term plays, I think is going to sort of match the risk adversity versus welcoming risk a little bit. Like because I am truly risk averse, and Albert knows this, I'm very much a long term sort of an investor. I'm not looking to sell all the time. And I feel like it's a little too overwhelming for me personally, but two, I like to set my investments, almost not forget it, but just check in on them like sort of once in a while and then kind of look and say, oh, you know what, like this year, this company didn't do great. But when you look at the 5-year, right, you're like, oh, actually, like they're 50, 60% up. It's like that makes it, to me, a little bit more risk adverse. So I think those are the elements that you can begin to layer in based on the tools that we're introducing you to. Ultimately, that's why this is not financial advice. There's still a lot of things you have to consider when making the decision. But Albert, sorry, I cut you off.
Yeah, no, absolutely. I think that was a perfect segue to kind of continue this conversation, right? Diversification is key, right? I truly think a key to a successful, sort of investment plan is asset allocation, or to your point, in other words, diversification, right? Allocating your risk so that you're able to achieve your goals, but also, again, going back to what I was saying earlier, being able to sleep better at night, right? You're not, constantly worrying about what your portfolio is looking like. And so, on that, and going back to what Ben's, was saying earlier was, this idea of compounding, ties to a saying that we often say is time in the market is better than timing the market, right? We never want to time the market of when to go in. And that just goes back to starting earlier. Now, Ben kind of scrolled down, and the next two sort of things on the screen is two types of vehicles to consider when building a portfolio, right? Earlier, we talked about stock and bonds. You can go out and buy individual stocks and bonds, and that's fine, right? You can go and pick those individual companies. But oftentimes, because of the importance of diversification and asset allocation, utilizing what's called exchange-traded funds or mutual funds becomes a very important tool to get further diversification. So both of these are baskets of stock or baskets of bonds that you can purchase in one, sort of line item or one wrapper, for lack of a better term, that gets you the diversification of a lot of different companies that's, sitting underneath, right? So, kind of breaking that down, an exchange traded fund is essentially a basket of stocks that tracks a certain index. Ben uses the S&P 500 in his spreadsheet, and so we'll use that. So the S&P 500 tracks the largest 500 companies. If you buy an ETF that is linked or tied to the S&P 500 index, when you buy a share of this ETF, you're essentially getting access to all 500 companies. Right. And so, and oftentimes, we call an exchange traded fund a passive investment. That comes with a little bit of an asterisk these days. There's a lot of very unique ETFs out there now. But traditionally, and I'm just going to speak kind of broadly on it, it's typically seen as a passive investment because what it does is it just tracks the index, right? So unless there's a change in the S&P 500, if a company drops off, a new company gets added on, there's not going to be a lot of changes in that portfolio. You stick with that basket. Okay. And that's absolutely fine, right? Because you just kind of roll with the market. Right. The other one is called a mutual fund. And the mutual fund is similar to an ETF in the sense that it's also a basket of stock, but we often consider that an active sort of investment vehicle. The idea is similar in that the mutual fund is benchmarked to a index, for example, again, the S&P 500. But there's typically a active manager or a fund manager involved where they're going in and actively choosing the 500 companies that they want to hold. Instead of holding all 500, they may pick, 50 to 100. Right? They say, hey, these 50 to 100 are going to be the cream of the crop of the S&P 500. And we think by holding just these, right, we're going to outperform. So that's traditionally the idea of a mutual fund, right? And I think, depending on going back to what your risk tolerance looks like, what your sort of investment objectives are, either or, right, certainly could make sense in any one person's portfolio, right? And so I think, ETFs traditionally also typically have a little bit of a lower internal cost, right? So if you think of these mutual funds as essentially their own type of company, right, someone's managing it, right? So there's a little bit of a cost involved. So with ETFs, because there's not a lot of trading, there's not a lot of turnover underneath, the expenses, the internal expenses, typically are lower than when compared to a mutual fund, right? Because a mutual fund has a fund manager, they have analysts, they're constantly talking to these companies, trying to listen to the earnings report, et cetera, et cetera. And so that's kind of where it's been at. Now, I caveated earlier with an asterisk because today there are also active ETFs out there. There's just so much out there. So again, this is just more about the education, right? I highly encourage everyone to do their own research when looking to invest in either of these vehicles or any of the sort of topics we've discussed today. But I just wanted to throw that out there, right? Because there's a whole universe out there of this stuff, and it can get somewhat overwhelming. But I think if you just kind of do a little bit of homework, do some research, it certainly will put you on the right track. So bring it all back to the two scenarios, right? I think, we briefly touched on, Ben being, somewhat starting out more recent and a little more risk averse. I think, in the survive category, obviously, we already talked about both should cover, everything, right? Both Tyler and Ben should have that done, sort of covered. In this strive category, Ben's portfolio may look drastically different than Tyler's portfolio. Right. Again, going back to what I was saying, from a diversification perspective, Tyler may have an appetite to, maybe hold a little bit more of these riskier equities, right? Smaller companies, maybe even international, so on and so forth. Where Ben is just like, hey, you know what? I just want the S&P 500. Historically, that's great. Just leave it, let it roll. Right. And then there are some investors too who like to be a little more active on their own and trade and all that. And that's okay too. Right. But I would just encourage, do it with a purpose. Right. Again, it goes back to, I always say everything should be goals based. Right. There should be an end that means the end. It's not just you're just there, day trading or just trading for funsies. I highly encourage to really have a plan. Right. Ultimately, I think that's kind of where we want to strive for.
Important question for you. Is there a mutual fund that trades in boba stores or like hand picks, is that, or how could we create, what if we create our own mutual fund? Can nonprofits create mutual funds? Maybe not.
Yeah, well, you got to have boba stores that are publicly traded first, right? I don't know if
I'm sure there are a handful. Can you do some research and let us know? Like, is there like a boba fund or something like that? That's been the hard-hitting questions.
Our stock ticker would be Boba, and it would be called Boba.
Yeah, look at that. You already got a ticker already.
Done for it. But no, I wanted to. It's interesting that we're talking about the strive phase. One thing I wanted to bring up, because it just got me thinking about kind of honestly my own career progression and money progressions personally, but I would add to the conversation that we're having the concept of liquidity. Just because I think that when we look at the strive phase right now, we're looking at it as kind of these more advanced vehicles for investment. But when you kind of get to a point where you're ready to enter the strive phase, it doesn't necessarily mean divest everything that you've done in your survive phase, your high yield savings and all these tools, and like move it all into these different vehicles. That's probably not a great idea. And that's because there's still going to be those times where you need cash and you have that emergency, or you move and you need money in order to kind of capitalize on an opportunity or an apartment or, even food, whatever it is. And these investment vehicles that we're talking about, their liquidity is not as straightforward because you're putting your money into something for a period of time more than likely. And so if you do need, you will inevitably, I should say, need cash. And so you shouldn't forget about the other stuff that we learned about earlier in the episode. These are just additional vehicles once you're at a level where you have both your savings and your ability to save further.
Yeah, I think about it as building blocks, right? Different steps along the way. And so I think the way you guys really structure this makes a lot of sense, which is great.
Yeah, people are just out here trying to survive. And then once you're past that, you're ready to strive. And once you're past that, and we will move on. And we'll kind of move on. I think the thrive topic will probably save one, because I think most folks are in the survive, strive category. But also, since this is a two-parter, we can use that time to talk about areas where people can really begin thriving. But Albert, I would love to invite you to give us like a 1 minute sort of foreshadowing topic on what would be discussed, or what are some examples of things you would discuss in the Thrive category before Tyler closes us out for the episode.
Sure. I think, once you've really got your footing down, right, and, it may be a house might be involved. I think a big topic of conversation that often is missed is it's called estate planning. Right. I got all this stuff now. I need to protect myself. I need to protect my family. What does that look like? Right. And it does become a little bit of a confusing topic at times, because often it's not taught in schools. Right. It's not something that it's so confusing. And sometimes people hear, oh, I got to get a lawyer involved. That's kind of another hurdle I got to cross. So I think that would be another topic of importance that, we love to dive into further at the next opportunity.
Love it. I think honestly, that's one of those steps where I don't know where I am on this. I think I'm somewhere in Strive and Thrive. Maybe I'm a little bit older, but I still haven't gotten my estate planning in check. So clearly I'm already behind on the right steps, but I'm excited for that episode because I'm bound to learn something and probably protect my future, maybe kids, if I end up having them because of it. So in any case, as we wrap up this episode, we'll do something I love to always do, which is kind of what's the one takeaway or one thing to remember from this episode. I'll pass it first to Albert, our special guest, to give us this.
Yeah, sure. I think the one takeaway I would give to the audience is really the avoiding the pitfall of comparison, right? Earlier, we kind of briefly touched on it. Everyone is going to be on a different path. And I know it's hard not to compare yourself to, the person next to you or your network. But I think it's all relative, right? Oftentimes I hear, oh, I'm behind, right? Behind is really a relative term. Like, what are you behind to, or who are you behind to, right? Like, I think, really the goal is to create a plan, utilize that plan, and execute on that plan, right? And so the goal is to get, again, from A to B, goals based, right? Have a plan, have a regimen set out where it's actionable, you can stay cognizant of it. So I just encourage everyone to not get into that pitfall, right? And just, you are where you are, be proud of it, and just keep, striving, right? And eventually we'll thrive.
There you go. I can go next. I think for me, I've learned that financial planning is a very personal activity. Like, even the things that we said, there are many people, I'm sure, which a lot of these won't necessarily impact, because that's just not who you are. Like, you're not that type of person who wants to read about ETFs or wants to, and that's totally okay. Because ultimately, I think you have to pick the thing that works for you, because if you don't keep it up yourself, then it's not going to work for you. If you forget that you invested some money in this fund and you never go back to it, that's not really good savings. And I also see a lot of get rich quick stuff on social media all the time. Dudes driving a Porsche. Oh, I bought a quadplex and now I rent it out and now I can make all this money. It's like it's just like a celebrity or like a star athlete. To me, it's like there are cases where that people can be successful in that, but there are more people who are not successful than are successful. And if there's a lot of things that you hear that sounds too good to be true, it could be, right? People can unfortunately try to trick you out of your money and say, oh, invest with me. You see, we have to be really careful about not trying to, get rich quick type of thing, but also layering in your personal preference for risk, how long you're willing to invest, how much money you're willing to invest, and then again, your own personal preferences. So to me, just very personal, and you have to do a little bit of introspection. And then hopefully this episode just gives you a list of things to Google to then match that introspection so you can start figuring out what makes sense for you.
Love it. And I'll bounce off that for my final take, which is, I think that the best time to start is now. And the best thing that you can do in the immediate term is just find the information, regardless of your existing financial standpoint, whether you have a job, whether you don't, whether you're trying to figure things out. Just arming yourself with the information as to what's possible is going to set you up for success when you are ready to jump into any of the vehicles that we've talked about today. And I think that the more and more that you can just have the information, as you move forward in your career, as you move forward in your life, and you understand the different expenses that you have, you'll just have more opportunity to say, oh, here's where I am. Here's where I should put my money based on the situation that I'm in. And the more information you have, again, the better you're set up to just take care of yourself and take care of your wealth as it grows for the future. So that's it for today's episode. We're excited again to welcome Albert on for our live episode that's coming next. Again, look out for more details on that soon. But we'll be around to kind of have Albert take a look at your live questions and some of the other burning questions that you have. So please look out for that. And we're excited to host you then. But until then, thank you again for tuning in to this episode of Beyond the Books. And remember, the best chapters in life are the ones that you write yourself. We'll see you next time.
Awesome.
Thanks.
Thank you.
Thank you.